So, you want to own Apple, not an iPhone, not a MacBook, not a few shares of stock sitting quietly in your investment portfolio. You want the whole company, every iPhone sold in New York, every MacBook opened in London, every Apple Watch activated in Dubai, every pair of AirPods connected in Tokyo, every app downloaded through the App Store, every payment flowing through Apple's ecosystem, every chip, every patent, every store, every subscription, everything. It sounds like the ultimate billionaire fantasy. Because Apple Inc. isn't just a technology company. It's one of the most powerful consumer businesses ever created. A company capable of taking glass, aluminum, silicon, software, and turning them into products that hundreds of millions of people willingly line up to buy. Again, and again, and again. But here's the strange part. Apple doesn't simply sell technology. Plenty of companies sell technology. Apple sells something much harder to manufacture. Desire. Now imagine this. It's 7:42 on a quiet Monday morning. You're still at home. Coffee on the table. Markets haven't opened yet. Then, your phone rings. The irony? It's an iPhone, you answer. On the other end is one of the largest investment banks in the world. The voice is calm, professional, almost too calm for what you're about to hear. We've been authorized to approach a very small group of potential buyers. You wait. Then comes the sentence. Apple is available. Silence. You look down at the phone in your hand. The company that made the device you're using is apparently for sale. At first, you assume there's been some mistake. There hasn't. The board is willing to entertain an offer. Major shareholders are prepared to negotiate. Law firms have been placed under strict confidentiality agreements. Banks are already assembling financing teams. The asking price? Several $trillion. Not several million, not several billion. Trillion, with a T. More money than the annual economic output of most countries on Earth. Enough money to buy entire industries. Enough money to build cities. Enough money to make even the world's richest people look underfunded. Your advisors immediately begin running the numbers. Bankers start calling. Sovereign wealth funds request meetings. Governments quietly ask questions. And somewhere inside a conference room, a document is placed in front of you. All you have to do is decide. At first, the decision looks obvious. You're buying the iPhone, one of the most successful consumer products ever created. You're buying the Mac, the iPad, the Apple Watch, AirPods, the App Store, Apple Music, iCloud, Apple TV+, Apple Pay, a global retail network, a powerful software ecosystem, and a brand so influential that a product launch can become international news. What could possibly go wrong? Well, almost everything. Because before a single dollar of profit reaches your bank account, before the next iPhone appears inside an Apple store, before the cameras turn on, before the applause, before millions of customers begin placing orders, you first have to coordinate one of the most complicated supply chains on Earth. Think about the iPhone in your hand. It looks simple. One screen, a few cameras, a metal frame, a battery, a logo. But inside that device is a global economic puzzle. Advanced processors, memory chips, camera sensors, display technology, rare materials, glass, precision machined components, wireless systems, batteries, semiconductors, software, parts sourced through a vast international network. One product, dependent on suppliers and manufacturing partners spread across the world. And here's where owning Apple becomes terrifying. You don't get to be late. Customers don't care that a supplier had problems. They don't care that a shipment was delayed. They don't care that a factory lost power. They don't care that geopolitical tensions disrupted production. They don't care that one microscopic component failed quality control. They expect the product, on time, at scale, perfect. Because when you charge premium prices, customers expect premium execution. Imagine the pressure. Millions of people are waiting for your next iPhone. Retail stores are preparing displays. Telecom companies are planning promotions. Reviewers are waiting. Investors are watching. Competitors are studying every rumor. You have one launch window. Then, 3 weeks before release, a critical supplier calls. There's a problem. A component isn't meeting quality standards. Now you have a decision: delay the launch and disappoint the market, ship anyway and risk a global product failure, or find another supplier capable of producing millions of precision components almost immediately. This is what owning Apple actually means. The public sees the keynote. You see the crisis happening behind it. And then comes another problem: success. Because once you build one of the most successful products in history, the world expects you to do it again, and again, and again. Think about how absurd that pressure is. A small company can launch a bad product and recover. Apple can disappoint investors simply by launching an excellent product. That isn't excellent enough. Every year, customers expect better cameras, faster processors, longer battery life, smarter software, thinner designs, new features, better integration, more innovation. But somehow, they also expect the device to feel familiar. Change too little, and people say Apple has stopped innovating. Change too much, and you risk alienating the customers who loved the original product. That's not product development. That's a balancing act worth trillions of dollars. But here's where the story becomes even more interesting. Because the iPhone may be the product everyone sees, but the real business is much larger. Imagine someone buys an iPhone. The transaction looks finished. It isn't. They buy AirPods, then an Apple Watch, then a MacBook. They pay for iCloud storage, download apps, subscribe to music, watch entertainment, make payments, buy accessories. And suddenly, one customer becomes part of an ecosystem. The more products they buy, the more convenient everything becomes. Photos move between devices, messages synchronize, files appear automatically, headphones connect, watches unlock computers, payments flow through the same account. Leaving becomes possible, but increasingly inconvenient. And that may be one of the most powerful economic advantages Apple has ever built. The first product gets you through the door. The ecosystem gives you reasons to... Now imagine owning that ecosystem. Hundreds of millions of people waking up every morning reaching for a device connected to your business. Some check messages, some listen to music, some pay for storage, some download apps, some buy new devices, some replace old ones, some subscribe to services. The money doesn't arrive from one direction. It arrives from everywhere. Hardware, software, services, subscriptions, accessories, payments, advertising, relationships, digital marketplaces, one customer, multiple revenue opportunities. That's the dream. But dreams this large create equally large risks, because Apple has another weakness, one that hides inside its greatest strength: expectation. The world expects Apple to win. Every year, every product cycle, every launch, every technological shift. And when you're already one of the most valuable companies on Earth, winning isn't enough. You have to keep finding entirely new mountains to climb. The personal computer, the iPod, the iPhone, the iPad, the Apple Watch. Each successful category raised the question, what's next? And if you're now the owner, that question belongs to you. Today, we're going to put ourselves in that position, not as customers, not as fans, not as shareholders with a tiny piece of the company, as the person responsible for the entire empire. Together, we'll answer the questions every billionaire, every sovereign wealth fund, and every serious investor would ask before attempting the biggest purchase of their life. How much would Apple actually cost? What are you really buying? Where does the money come from? Why can Apple charge premium prices in brutally competitive markets? How does a company that designs products in California coordinate production across a global supply chain? What happens if the iPhone stops growing? What happens if the next major technology revolution leaves Apple behind? And perhaps the biggest question of all, would owning Apple be one of the greatest millionaire decisions ever made? Or would you be paying trillions of dollars for a company the world already expects to be perfect? Before we find out, If you enjoy exploring the economics behind the world's biggest companies, industries, and investments, subscribe to Millionaire Decisions. And here's today's question. If someone handed you enough money to buy Apple today, would you take the deal? Or would you invest those trillions somewhere else? Tell me your decision in the comments. Now, let's find out what owning Apple would actually cost. So, you've made your decision. You want Apple. The bankers have been called. The lawyers are working through the night. Financial institutions are preparing. Governments are watching. And now, someone slides the first document across the table. At the top is a number so large that even billionaires would need help reading the check. Because buying Apple isn't a billionaire purchase. It's something much bigger. Let's begin with the obvious question. How much would Apple actually cost? The first answer seems simple. Look at the stock market. Find Apple's total market value. And there's your price. Except, that's not how buying an entire public company works. Because the moment you announce that you want all of Apple, everything changes. Shareholders don't have to sell. Some will demand more. Others will refuse. Traders will speculate. The stock price could move. Regulators will react. Competitors will prepare. Politicians will ask questions. And suddenly, the price displayed on a financial website becomes only the beginning of the negotiation. Imagine Apple is valued at several $trillion. You can't simply transfer that amount and expect every shareholder to hand over their shares. To convince enough owners to sell, you may need to offer a premium. Maybe 10%, maybe 20%, maybe more. And when you're dealing with a company worth trillions, a small percentage isn't small anymore. A 10% premium on a $3 trillion valuation? That's another $300 billion. Just to make the offer more attractive. Think about that. The premium alone could be larger than the value of many of the world's most famous companies, and you still haven't completed the purchase. Then comes financing. Let's be clear, no individual on Earth can simply open a banking app, tap send, and transfer several $1 trillion. Not even close. The wealthiest people in the world hold much of their wealth in shares, businesses, real estate, and other assets, not giant piles of cash waiting in a bank account. So if Apple were ever purchased outright, the deal would likely require a financial coalition unlike anything the world has seen. Sovereign wealth funds, global banks, pension funds, institutional investors, private capital, perhaps multiple governments, possibly some of the largest financial organizations on Earth, all sitting around the same table. And that's when the first major problem appears: debt. Suppose you borrow a huge portion of the purchase price. Now, Apple doesn't simply need to remain profitable. It needs to remain profitable enough to service one of the largest debt structures ever imagined. Interest payments could become enormous. A small increase in borrowing costs could translate into billions more in annual expense. And suddenly, the company famous for its financial strength could become weighed down by the financing used to buy it. That's the strange paradox of acquisitions. Sometimes, the asset is excellent, but the price destroys the investment. You can buy the best business in the world and still lose money if you overpay. But let's imagine you've solved the financing problem. The money exists, the investors agree, the banks are ready. Now, you face something money can't easily solve: regulation. Because Apple isn't just a company selling phones. It operates digital marketplaces, payment systems, software platforms, cloud services, media services, advertising relationships, hardware ecosystems, and a global distribution network. Its decisions affect developers, banks, telecom companies, governments, media businesses, millions of customers. So the moment someone attempts to take complete control, regulators would ask uncomfortable questions. Who is the buyer? Where does the money come from? Would the transaction reduce competition? Could the new owner influence digital markets? What happens to user data? What happens to national security? What happens to suppliers? What happens to developers who depend on the platform? At this scale, buying Apple isn't simply a business deal. It's a political event. And suppose, against all odds, the deal is approved. Congratulations, you now own Apple. But here's where most people misunderstand the economics. You didn't just buy the iPhone Pro, you bought an obligation. An obligation to keep one of the most demanding machines in global business running. Because Apple doesn't get to disappear for 6 months and reorganize. Customers expect new products. Developers expect software updates. Stores need inventory. Suppliers need forecasts. Cloud systems need maintenance. Security vulnerabilities need patches. Millions of devices need support. The business never stops. Let's begin with research and development. Every product that appears simple on stage may represent years of invisible work. Chip design, battery engineering, display technology, camera systems, materials science, software, artificial intelligence, health technology, security, industrial design, manufacturing processes, thousands of engineers working on products the public may not see for years. Some projects succeed, others disappear. That's the price of innovation. For every breakthrough customers celebrate, there may be countless prototypes that never leave the laboratory. Owning Apple means funding both, the winners and the failures. Then comes something most customers never see: the supply chain. Apple's products depend on a vast network of suppliers and manufacturing partners. A chip may be designed in one place, fabricated somewhere else, packaged elsewhere. A display may come from another supplier, camera components from another, memory from another. Final assembly may happen through major manufacturing partners. Then finished products must move through airports, ports, warehouses, distribution centers, retail stores, and delivery networks around the world, all synchronized around launch dates that millions of customers already know. This is not ordinary logistics. It's choreography, global choreography, and one mistake can become very expensive. Imagine you're preparing the next iPhone launch. You expect enormous demand, so you commit billions to components in advance. Displays, processors, camera modules, memory, batteries, casings, packaging. Then, demand comes in weaker than expected. Now, you have too much inventory, too many components, too much production capacity. Billions of dollars tied up in products customers aren't buying fast enough. But suppose you make the opposite mistake. You underestimate demand. The phone sells out. Customers wait weeks. Retail shelves go empty. Competitors begin advertising alternatives. Now you're losing sales because you didn't build enough. This is the impossible game. Produce too much, and you waste capital. Produce too little, and you leave money on the table. Then comes the cost of being premium. When people buy a cheap device, they may forgive imperfections. When they buy an expensive Apple product, they expect precision. The packaging must feel right. The screen must look right. The buttons must feel right. The software must work. The camera must perform. The battery must last. The store experience must feel premium. Even the box matters. That level of consistency is expensive. Quality control is expensive. Returns are expensive. Warranty support is expensive. Repairs are expensive. Customer service is expensive. But that's the price of maintaining a premium brand. Because Apple isn't only selling the product, it's selling confidence in the product. Now let's talk about retail. Most technology companies would be terrified of opening hundreds of premium stores in some of the most expensive locations on Earth. Apple did it anyway. Think about the cost. Prime real estate, architectural design, glass structures, custom interiors, employee training, inventory, security, maintenance, electricity, and thousands of staff. Why spend so much? Because the stores aren't just stores. They're marketing, they're customer service, they're product demonstrations, they're repair centers, they're brand temples. A customer can walk in, touch the product, ask questions, get support, and walk out deeper inside the ecosystem than when they entered. Expensive? Absolutely. But strategically powerful. Then comes another invisible cost: software support. Imagine selling hundreds of millions of devices. Now imagine maintaining software for them: security patches, operating system updates, bug fixes, developer tools, cloud synchronization, accessibility, privacy features, language support, payment infrastructure, app review, fraud detection, customer accounts. Every feature creates responsibility. Every new device expands the network you must protect. And every security failure could affect millions of people. Then there's the App Store. From the outside, it looks like a digital shop. Inside, it's a massive global operation. Developers upload applications. Apple reviews them. Payments are processed. Fraud is monitored. Subscriptions are managed. Refunds happen. Rules are enforced. Governments challenge policies. Developers dispute fees. Customers expect security. The App Store can generate enormous economic value, but managing it also creates legal, political, and reputational pressure. Owning a platform is powerful. It also means everyone blames you when something goes wrong on that platform. Now, we reach one of the biggest costs of all: semiconductors. Modern Apple products depend on advanced chips, and Apple has increasingly invested in designing its own silicon. That decision gives the company extraordinary control: performance, efficiency, integration, product differentiation. But chip development isn't cheap. It requires elite engineers, years of research, advanced design tools, long-term manufacturing relationships, and access to some of the most sophisticated fabrication technology on Earth. One generation succeeds, and your products gain an advantage. One generation disappoints, and the consequences can spread across an entire product lineup. Then comes artificial intelligence, the next major battlefield. Customers increasingly expect devices to understand them, assist them, generate content, organize information, improve productivity, and interact naturally. That means Apple can't simply protect the iPhone business. It must compete in whatever comes after the smartphone. AI assistance, wearable computing, spatial interfaces, health technology, new device categories, new software experiences. The future is expensive, and the terrifying part? No one knows exactly what it looks like. That's what makes owning Apple different from owning a normal business. A restaurant can study last year's demand. A hotel can forecast occupancy. A factory can estimate production. But a technology company must invest billions into a future that may not exist yet. You're making decisions today about products customers may want 5 years from now. Get it right, and you create the next iPhone. Get it wrong, and billions disappear quietly. So, let's add everything together: the acquisition price, the takeover premium, financing costs, regulatory approvals, research and development, chip design, artificial intelligence, software, cybersecurity, retail stores, global logistics, supplier commitments, inventory, marketing, employee compensation, customer support, cloud infrastructure, content services, acquisitions, and the constant cost of trying to invent whatever comes next. By now, the real economics become clear. Buying Apple may cost several $1 trillion, but keeping Apple, requires something even harder than money. It requires execution, year after year, product after product, decision after decision. Because you aren't buying a finished empire, you're buying an empire that must continuously prove it deserves to exist. And yet, despite all of these costs, despite the supply chain complexity, despite the pressure, despite the billions required to keep innovating, Apple has built one of the most extraordinary money-making systems in corporate history, which raises the next question: where does all that money actually come from? Because the real secret of Apple isn't that it sells expensive iPhones. It's what happens after the first iPhone enters your pocket, and that's where Chapter 3 begins. You've done it. You've spent several $1 trillion buying Apple. The lawyers are exhausted. The bankers have finally stopped calling. Regulators have signed off. Shareholders have accepted the deal. The headlines have begun to fade. And for the first time, you wake up as the owner of one of the most valuable businesses ever created. Now comes the question that actually matters. How do you make your money back? At first, the answer seems obvious. Sell iPhones. Lots of them. And yes, that would be a good place to start. Because somewhere in the world right now, someone is holding an iPhone with a cracked screen, a weakening battery, an outdated camera, and a growing suspicion that maybe, just maybe, it's time for an upgrade. That moment matters to you, because the instant they replace that phone, your machine starts moving. Again, let's begin with the product at the center of the empire, the iPhone. For most companies, a smartphone is simply a product. Build it, sell it, collect the money, move on. For Apple, the iPhone is something much more powerful. It's the front door. Think about it. A customer buys their first iPhone. Maybe that's all they wanted, just a phone. Then they need cloud storage, so they start paying for iCloud. They want wireless earbuds, so they buy AirPods. They start exercising. Now, an Apple Watch makes sense. They need a laptop. A MacBook becomes attractive because it works smoothly with the phone they already own. Then comes music, apps, subscriptions, accessories, payments, entertainment. One purchase creates the possibility of another, and another, and another. That's the first major lesson you learn as Apple's owner. The iPhone isn't only a product, it's customer acquisition. Imagine you own a luxury hotel. A guest checks in once, pays for the room, leaves. You hope they return next year. Apple's model is different. Apple sells you the hotel room, then the key, then the restaurant downstairs, then the gym membership, then the transportation service, then the entertainment package, and somehow, each additional purchase makes the original purchase more useful. That's the ecosystem. And economically, it's brilliant, because the more deeply customers move into that ecosystem, the more expensive switching becomes. Not always in money, sometimes in inconvenience. Your photos are synchronized, your messages appear across devices, your AirPods connect automatically, your watch tracks your health, your laptop receives files from your phone, your passwords are stored, your payment cards are connected, your subscriptions are active. Could you leave? Of course. But now, leaving means rebuilding parts of your digital life somewhere else. And most people hate inconvenience. This is where Apple's economics begin to separate from ordinary hardware companies. A competitor may sell a phone. Apple sells a relationship. The phone can be replaced every few years. The relationship can last decades. And long relationships are valuable, very valuable. Now let's follow the money. Suppose a customer walks into an Apple store and buys a premium iPhone. The price might be close to, or even above, $1,000. Most people look at that number and assume Apple keeps most of it. Not quite. The device has costs: semiconductors, displays, camera systems, memory, batteries, glass, assembly, shipping, packaging, warranty support, research, marketing, retail operations, software development. But here's the important part. Apple has spent decades building something most manufacturers desperately want: pricing power. Pricing power means customers aren't simply asking, what is the cheapest phone available? They're asking, what is the newest iPhone? Those are very different questions. One creates a commodity, the other creates a brand. And when customers care deeply about the brand, you gain room to charge more. That's why Apple's greatest factory may not be located in China, or India, or anywhere else products are assembled. Its greatest factory exists inside the customer's mind, because Apple has learned how to manufacture perception: premium, simple, desirable, reliable, status, trust. That perception allows the company to operate differently from manufacturers competing almost entirely on price. But the iPhone is only one layer. Now comes the Mac. For decades, the personal computer market has been brutally competitive. thin margins, constant price pressure, countless manufacturers. Apple chose a different path. Instead of trying to sell the cheapest computer, it built tightly integrated hardware and software. The company controls the operating system, the industrial design, the user experience, and increasingly, the chips inside the machine. That matters, because when one company controls more of the stack, it can optimize the entire product around itself. The software knows the hardware. The hardware is designed for the software. The chips are built for both. This is vertical integration, and when it works, it can create extraordinary advantages. Then comes the iPad, the Apple Watch, AirPods, accessories. At first glance, these look like separate product categories. Economically, they're connected. The Apple Watch becomes more useful when paired with an iPhone. AirPods become more convenient across Apple devices. The iPad works with the same account. The Mac communicates with the phone. Each product strengthens another. Imagine owning 5 restaurants on the same street and discovering that every time someone eats at one, they're more likely to visit the other 4. That's the power of the ecosystem. But now, we reach the part of Apple's business that changes everything: services. Because hardware has one annoying problem: you have to build it every single time. If you want to sell another iPhone, you need another physical iPhone. More components, more assembly, more shipping, more inventory, more logistics. Services behave differently. Once the digital infrastructure exists, the economics can become far more attractive. A customer pays for iCloud storage, then pays again next month, and the month after that. A user subscribes to Apple Music. Another pays for Apple TV+. Someone buys an app. Someone makes an in-app purchase. Someone pays for additional storage. Someone uses a subscription tied into Apple's platform. One customer, recurring transactions. No new iPhone required. And that's the transformation many people miss. Apple may be famous for selling devices, but services can deepen the economics of every device already sold. Imagine hundreds of millions of active devices around the world. Every one of them becomes a potential storefront, a potential subscription terminal, a potential payment relationship, a potential source of recurring revenue. The device sale happens once. The economic relationship can continue for years. Now let's talk about the App Store. To the average customer, it's just a place to download apps. To you, as Apple's owner, it's a marketplace. Developers build the products, customers bring the demand. Apple operates the platform connecting them. Think about how powerful that is. A developer in Lagos builds an app. A customer in London downloads it. A gamer in Tokyo makes an in-app purchase. A business in New York pays for a subscription. Apple doesn't need to invent every application. It owns the infrastructure through which huge amounts of digital commerce can flow. That's a very different business from simply selling phones. And marketplaces have an interesting advantage. The more developers participate, the more useful the platform becomes. The more useful the platform becomes, the more customers want to stay. The more customers stay, the more attractive the platform becomes to developers. It's a cycle. Developers attract users, users attract developers. And sitting in the middle is the platform owner, you. Then there's iCloud, perhaps one of the least dramatic products in Apple's empire. No giant launch event required, no crowds lining up overnight, no dramatic camera demonstrations, just storage. But storage becomes important when your digital life depends on it. Photos, videos, documents, backups, messages, device synchronization. A customer may begin with free storage. Then one day, a notification appears. Storage full. Now, they have a decision. Delete years of memories or pay a small monthly fee. Most people don't enjoy deleting memories. And suddenly, another recurring payment begins. Small from the customer's perspective, potentially enormous at scale. That's one of the secrets of trillion-dollar economics. You don't always need one person to pay you a fortune. Sometimes, you need millions of people to pay you a little, repeatedly. Then comes Apple Music. entertainment, fitness, payments, advertising, relationships, warranty and support products, different businesses, different margins, different customers, but all connected to the same ecosystem. And that's where Apple's model becomes so difficult to copy. A competitor can build a phone, another can build headphones, another can create a streaming service, another can offer cloud storage. The difficult part is making all of them strengthen each other. Now consider Apple Pay. You open your phone, tap, purchase complete. From the customer's perspective, it feels like convenience. From the owner's perspective, it represents something larger. Apple has placed itself closer to the transaction, closer to the moment money moves. And in business, being close to the transaction can be extremely valuable. The company doesn't need to become a traditional bank to benefit from financial relationships around its ecosystem. It can build payment experiences, wallet infrastructure, partnerships, and services that make the device more useful. Once again, the product strengthens the ecosystem. The ecosystem strengthens the product. But perhaps the most fascinating part of Apple's economics is what it chooses not to own. Remember Chapter 2? Apple coordinates one of the most sophisticated supply chains on Earth. Yet it doesn't simply own every factory producing every component. Instead, it designs, specifies, negotiates, coordinates, controls key technologies, and relies on a vast network of specialized suppliers and manufacturing partners. This is one of the biggest strategic differences between Apple and a traditional industrial company. A car manufacturer may spend billions building enormous assembly plants. Apple can focus massive resources on design, software, chip architecture, brand, retail, and customer experience, while manufacturing partners handle significant parts of physical production. That doesn't make the business simple, far from it. But it changes where capital is deployed. And then we reach one of Apple's most powerful decisions: designing its own chips. Think about what that means. For years, many technology companies bought critical processors from outside suppliers. Apple increasingly chose another path: control more of the intelligence inside the product. Design chips around the experience it wanted to create. Now the processor isn't just another component, it's part of the strategy. A faster chip can improve performance. An efficient chip can improve battery life. A specialized chip can support new features. And because the company also controls the operating system, hardware and software can be developed together. This is where Apple's business starts to resemble something unusual. Not just a hardware company, not just a software company, not just a services company, but a vertically integrated technology ecosystem. Now, let's step back. You're the owner. Money enters from iPhones, Macs, iPads, wearables, accessories, services, subscriptions, apps, cloud storage, payments-related partnerships, support products, entertainment, and other parts of the ecosystem. If one product category slows, others can help. If customers delay upgrading their phones, services can continue generating revenue from devices already in use. If one region weakens, other markets may compensate. If hardware creates the installed base, services can deepen monetization. This is why Apple's business is more sophisticated than simply sell expensive phones. The phone is the beginning, not the end. But there's a problem, a very big one. Because when one product becomes the front door to your entire empire, you become dangerously dependent on that door remaining open. What happens if people stop upgrading? What happens if a competitor invents the next major computing platform? What happens if artificial intelligence reduces the importance of the smartphone? What happens if governments weaken your control over the App Store? What happens if geopolitical conflict disrupts manufacturing? What happens if customers decide the ecosystem feels less like convenience and more like a cage? Suddenly, the greatest strengths of the business begin to look like vulnerabilities. And that brings us to the chapter every trillion-dollar buyer should fear. Because making money with Apple is one thing, Keeping Apple on top is something else entirely. By now, you've seen the machine. The iPhone brings customers in. The ecosystem gives them reasons to stay. Services create recurring revenue. Premium branding protects pricing power. Custom chips strengthen products. Retail deepens the relationship. And a global supply chain turns ideas designed in California into devices sold around the world. From the outside, it looks almost perfect. A business so powerful, so profitable, so deeply embedded in modern life that failure seems impossible. But there's a dangerous word in investing: impossible. Because history is filled with companies that looked untouchable until the world changed. Kodak understood photography. Then photography went digital. Nokia understood mobile phones. Then the smartphone changed what a phone was. BlackBerry dominated mobile communication. Then touchscreens and app ecosystems rewrote the market. Intel became synonymous with computing power. Then new architectures and shifting markets changed the competitive landscape. The lesson isn't that these companies were stupid. Many were brilliant. The lesson is more frightening. You can be excellent at yesterday's game and still lose tomorrow's. So if you've just spent several $1 trillion buying Apple, your biggest question isn't how many iPhones can we sell this year? It's what replaces the iPhone. Let's start with the most obvious risk: the iPhone itself. The product that built the modern empire. The device that transformed Apple. The front door to the ecosystem. Now imagine smartphone upgrades slow. Not collapse, just slow. Customers keep devices longer, year after year. 3 years becomes 4, 4 becomes 5. The cameras are already good enough. The processors are already fast enough. The screens are already sharp enough. Suddenly, convincing someone to spend another $1,000 becomes harder. That's the danger of making an excellent product. Eventually, the old one may remain excellent for too long. Think about the economics. If customers upgrade frequently, demand renews itself. But if replacement cycles stretch, you need to find growth somewhere else. Higher prices, services, new markets, new product categories, more subscriptions. Each solution creates another decision. Raise prices too much, and customers resist. Push services too aggressively, and regulators notice. Enter new markets, and local competitors fight back. Create a new category, and you might spend billions on something nobody wants. There is no easy answer. Then comes artificial intelligence. And this may be one of the most important strategic risks Apple has faced in years. For decades, the smartphone has been the center of digital life. You tap icons, open apps, search, type, scroll. But what happens if AI changes that behavior? Imagine a future where people don't open 10 different apps. They simply ask an intelligent assistant to do something. Book the flight, edit the photo, write the email, order the food, compare the prices, schedule the meeting, summarize the news. Now ask yourself a dangerous question. Who owns that relationship? The phone manufacturer? The operating system? The AI model? The app developer? The cloud provider? Whoever controls that interface could become the new front door to the digital economy. And Apple cannot afford to lose the front door. That's the billionaire decision. Do you spend tens of billions building your own AI infrastructure? Do you partner? Do you acquire? Do you protect privacy, even if competitors move faster with data? Do you redesign the operating system around AI? Do you risk disrupting the app model that already works? Every option has consequences. Move too slowly, and competitors define the future. Move too quickly, and you may damage the ecosystem already generating enormous profits. This is the innovator's dilemma at trillion-dollar scale. Then there's competition. Most people think Apple competes with Samsung. It does, but that's only one battlefield. It competes with Google in mobile operating systems, services, artificial intelligence, and digital ecosystems. It competes with Microsoft in personal computing, productivity, services, and AI. It competes with meta platforms over future computing platforms. It competes with Samsung in smartphones and consumer electronics. It competes with streaming companies for attention, with payment companies around transactions, with cloud platforms, with chip designers, with device manufacturers, with startups that don't yet exist. Owning Apple means fighting wars in multiple industries simultaneously. And here's the problem with being the leader. Everyone studies you. Competitors buy your products, take them apart, analyze the materials, study the software, examine the chips, copy the features, improve the weaknesses. A small company can surprise the market. Apple rarely gets that luxury. Rumors appear months before launches. Supply chain leaks reveal components. Analysts predict features. Competitors prepare responses. You're trying to innovate while the entire world watches your hands. Then comes regulation. This may be one of the most immediate threats to the economics of the ecosystem. Remember the App Store, the marketplace, the platform, the connection between developers and customers. Governments increasingly ask difficult questions about the power of large digital platforms. Should Apple control which apps reach users? Should developers be allowed alternative payment methods? Should competing app stores be permitted? Are platform fees fair? Does ecosystem control reduce competition? These aren't academic questions. They can affect billions of dollars. A regulatory change in one major market can force changes elsewhere. And suddenly, a business model refined over years may need to be redesigned. This is where owning a platform becomes complicated. Control creates profit. Control also attracts scrutiny. The tighter the ecosystem, the stronger the customer experience can become. But the tighter the ecosystem, the more regulators may ask whether one company has too much power. As owner, you're constantly balancing both. Open the platform too much, and you may weaken control. Keep it too closed, and governments may force your hand. Then comes geopolitics, and this is where the risk becomes much larger than technology. Apple's supply chain is global. Its customers are global. Its suppliers are global. Its political exposure is global. Now imagine tensions rise between major powers. Trade restrictions appear. Tariffs increase. Export controls tighten. A critical technology becomes unavailable. Shipping routes are disrupted. Factories face restrictions. Consumer sentiment changes. Suddenly, a decision made by politicians thousands of miles away can affect your next product launch. That's the reality of owning a global company. You don't control the world. You simply depend on it. And supply chain concentration creates another problem. Efficiency often encourages companies to build around the best partners, the most capable manufacturers, the strongest supplier clusters, the deepest technical expertise. That can produce extraordinary results until something happens in the region you've come to depend on. A pandemic, a natural disaster, a political conflict, a power shortage, a trade dispute. Now, efficiency becomes fragility, and diversification becomes expensive. Do you move production? Where? How quickly? Can another region match the quality? Can it match the scale? Can suppliers move too? How many billions will it cost? This isn't just logistics, it's strategy. Then there's China. And for Apple, China represents a uniquely complicated decision. It's an enormous consumer market, a critical part of global electronics manufacturing, a source of supply chain expertise, but also a market with intense competition and geopolitical sensitivity. Local smartphone manufacturers continue improving. Customers have alternatives. Governments have priorities. National sentiment can shift. So, as owner, you face an uncomfortable reality. One of your most important markets can also be one of your most complicated risks. Then comes another threat: the brand itself. Remember what we said in Chapter 3? Apple's greatest factory may exist inside the customer's mind. Premium, simple, desirable, trusted. But perception is fragile. Imagine one major privacy scandal, one catastrophic security failure, One product that seriously harms customers. One internal crisis handled badly. One launch that becomes a symbol of arrogance rather than innovation. The financial loss matters, but the deeper damage is emotional. Because premium brands depend on belief. The customer must believe the product is worth more, believe the experience is better, believe the company can be trusted. The moment that belief weakens, pricing power can weaken with it. And Apple has another unusual challenge: its own history. Think about the standard the company is measured against. The Mac, the iPod, the iPhone, the iPad. Products that didn't merely compete, they helped reshape categories. Now imagine launching a perfectly successful product, one that generates billions, and the market still asks, but is it the next iPhone? That's an almost impossible standard. Most companies are rewarded for growth. Apple is often expected to reinvent the future. This is where your role as owner becomes psychologically dangerous. You have trillions of dollars in value to protect. That can make caution attractive. Why risk the iPhone? Why disrupt the App Store? Why cannibalize the Mac? Why create a product that could make today's products less important? Because if you don't, someone else might. One of the hardest decisions in business is destroying your own advantage before a competitor does it for you. And Apple knows this better than most. The iPhone weakened the importance of the iPod. The iPad challenged assumptions about personal computing. Custom silicon changed the company's dependence on outside chip roadmaps. Innovation often requires a company to attack its own past. Could you do that? With trillions of dollars at stake? Now let's return to that Monday morning. The phone call, the iPhone in your hand, the investment banker, the offer, several $1 trillion. Would you still buy Apple? Let's think like a billionaire. You wouldn't ask, is Apple profitable? Of course it is. You wouldn't ask, is the brand powerful? Obviously. You'd ask harder questions. Will the iPhone still be the center of digital life 10 years from now? Can Apple win in artificial intelligence? Can services keep growing if regulators weaken platform control? Can the supply chain survive a major geopolitical shock? Can the company reduce concentration without destroying efficiency? Can Apple invent another category large enough to matter? And perhaps most importantly, can the company remain Apple after the people who built today's success are gone? Those are the questions that determine whether you're buying the future or paying a premium for the past. But here's what makes the decision so difficult. For every risk we've discussed, Apple has an advantage. Smartphone growth slows, it has a massive installed base. Competition intensifies, it has one of the strongest brands in business. Supply chains shift, it has enormous purchasing power and deep supplier relationships. Technology changes, it has vast financial resources to invest. Customers hesitate, it has an ecosystem designed to deepen loyalty. A weaker company might face one of these threats and collapse. Apple can face several and still have room to respond. That's what you're really paying trillions for. Not immunity from problems, the capacity to survive them. And perhaps that's the most important lesson in this entire video. Great businesses don't become great because nothing goes wrong. Things always go wrong. Products fail, markets change, competitors attack, governments intervene, technology moves. The best businesses become great because they can absorb mistakes, adapt, and keep moving. Apple has done that repeatedly, but the future doesn't care about the past. The next technological revolution won't give Apple special treatment because it created the iPhone. Customers won't remain loyal forever out of gratitude. Competitors won't stop innovating. Governments won't stop regulating. Every advantage must be defended, every year. So, after everything we've learned, the decision becomes much harder. You're not simply buying iPhones, you're buying dependence on the iPhone. You're not simply buying an ecosystem, you're buying the regulatory scrutiny that comes with controlling it. You're not simply buying a global supply chain, you're buying exposure to every shock that can hit it. You're not simply buying one of the strongest brands on earth, you're accepting responsibility for protecting that brand every single day. And yet, you're also buying one of the most extraordinary economic machines ever created. A company capable of turning customers into long-term relationships, devices into ecosystems, design into pricing power, and loyalty into recurring revenue. So now, only one question remains. After spending several $1 trillion, would owning Apple actually be one of the greatest millionaire decisions in history? Or would you be buying a perfect empire at exactly the moment the world is preparing to change again? It's time to make the final decision. So, let's go back to where this story began. It's 7:42 on a quiet Monday morning. Coffee on the table. Markets haven't opened yet. Then, your phone rings. The irony? It's still an iPhone. On the other end is one of the largest investment banks in the world. They offer you something almost no person in history could seriously consider. The opportunity to own Apple Inc. Not a few shares, not 10%, not a seat on the board. Everything. The iPhone, the Mac, the iPad, the Apple Watch, AirPods, the App Store, Apple Music, iCloud, Apple TV+, the stores, the patents, the chips, the ecosystem, the brand, all of it. At the beginning of this video, the decision sounded obvious. Now, it doesn't, because now you know what you're really buying. You're buying one of the strongest brands ever created, but you're also buying the expectation that it never disappoints. You're buying one of the most sophisticated supply chains on Earth, but you're also buying exposure to every disruption that can hit it. You're buying hundreds of millions of customer relationships, but you're also buying the responsibility to keep those customers loyal. You're buying extraordinary profits, but you're also buying an endless race against the future. So the question is no longer, can you afford Apple? The real question is, can you afford to keep Apple? Let's do the math. Suppose you somehow acquire the company for around $3 trillion. For simplicity, we'll ignore the fact that a real takeover could require a substantial premium above the public market value. We'll ignore the legal complexity, the regulatory battles, the financing structure, the political negotiations. Just imagine, $3 trillion. Deal complete. Now you own the company. What do you get in return? A business capable of generating hundreds of billions of dollars in annual revenue. A company with enormous global reach, one of the world's largest installed bases of active devices. A premium hardware business. A growing services ecosystem. A globally recognized retail network. And customer loyalty most companies would do almost anything to replicate. From the outside, that sounds extraordinary, and it is. But remember something, revenue is not your return. Profit matters, cash flow matters. The price you paid matters. Imagine Apple generates roughly $400 billion in annual revenue. That's an almost absurd amount of money. At that pace, the company could generate more revenue in a year than the entire annual economic output of some countries. But suppose annual net income sits around $100 billion, give or take depending on the year. Now, the investment begins to look different. You paid approximately $3 trillion for a business earning around $100 billion annually. On extremely simplified math, if profits never grew, if every dollar could somehow be returned to you, if taxes, reinvestment, financing, and countless other realities disappeared, you'd be looking at something like 3 decades of current annual earnings to equal the purchase price. 30 years. And remember, that's the simplified fantasy version. Real ownership doesn't work like that. Because you can't take every dollar of profit home. You need to reinvest, research, chip design, artificial intelligence, software, cybersecurity, retail, supply chains, new products, employee compensation, infrastructure, acquisitions, future technologies. Apple doesn't remain Apple because it made one brilliant product 20 years ago. It remains Apple because it keeps spending, building, testing, failing, learning, and trying again. So even if the company generates enormous cash, part of that cash must go back into protecting the machine. That's the first major conclusion of our decision. Apple may be an extraordinary business, but at a multi-trillion-dollar purchase price, you're also paying an extraordinary price for that quality. And this is where billionaire thinking becomes different. Most people ask, is Apple a great company? That's easy. Yes, but a serious investor asks, is Apple a great investment at this price? Those are not the same question. A magnificent business can become a poor investment if you pay too much. And an average business can sometimes become an excellent investment if you buy it cheaply enough. Price matters, always. Imagine buying a luxury apartment building. Perfect location, perfect tenants, perfect management, almost no vacancies. Everyone agrees it's the best building in the city. Wonderful. But then the seller asks you to pay 50 years of expected profits up front. Suddenly, the building hasn't changed. The investment has. That's the danger. When everyone already knows a business is exceptional, that optimism can already be reflected in the price. And Apple is not a hidden company. You're not discovering a forgotten business in a quiet corner of the market. The entire world knows Apple is powerful. Investors know. Banks know. Pension funds know. Governments know. Competitors know. You're paying for greatness with the whole world watching. So let's examine what could make the investment worthwhile. First, pricing power. This may be one of Apple's strongest advantages. Imagine two companies selling similar categories of products. One must constantly cut prices to survive. The other can charge a premium because customers perceive greater value. Which would you rather own? Exactly. Apple has spent decades building a brand that gives it room many competitors don't have. That doesn't mean customers will pay anything. They won't. But it does mean the company often competes on more than specifications alone. Design, trust, status, convenience, ecosystem, experience. Those things are difficult to copy, and difficult to copy advantages are valuable. Second, customer loyalty. Remember the customer from Chapter 3? They buy an iPhone, then AirPods, then a watch, then a MacBook, then iCloud, then apps, then subscriptions. At some point, you're no longer evaluating one product. You're evaluating an entire digital life. That's powerful, because customer acquisition is expensive. Keeping a satisfied customer can be far more valuable than constantly finding a new one. And Apple has built an ecosystem where one relationship can continue for years, sometimes decades. Third, the installed base. This may be one of the most underappreciated assets you're buying. Think about it. Every active Apple device is more than a product already sold. It's a potential future relationship, a future upgrade, a future subscription, a future accessory, a future service, a future app transaction, a future payment interaction. That means Apple doesn't start every morning with 0 customers. It wakes up with an enormous global network of people already connected to the ecosystem. For a business owner, that's incredibly powerful. Fourth, cash generation. Great businesses don't simply make accounting profits. They generate real cash. Cash gives you options. You can invest, acquire companies, build new technologies, survive recessions, return capital to shareholders, enter new markets, absorb mistakes, and perhaps most importantly, wait. Weak companies often know what they need to do, but can't afford the time required to do it. Strong companies can survive long enough to adapt. Apple's financial strength gives it that luxury. But now, let's examine the other side, because this decision isn't finished. The first major risk is obvious: concentration. The iPhone is not just another product, it's the center of gravity. It brings customers into the ecosystem. It supports accessories. It strengthens services. It connects devices. So what happens if the smartphone becomes less important? Not tomorrow, not next year, but over the next decade. That's the question, because technology doesn't ask permission before changing. The PC once looked permanent. Then mobile computing changed behavior. Physical music once looked permanent. Then digital distribution changed everything. The smartphone looks dominant today, but the future may belong to something else. AI-first devices, wearable interfaces, spatial computing, ambient computing, technologies we haven't named yet. If the center of digital life moves, Apple must move with it. Second, regulation. The ecosystem is powerful, partly because Apple controls so much of the experience: hardware, software, distribution, payments, platform rules. But that control attracts attention. If governments force major changes to digital marketplaces, payment systems, default services, or platform access, parts of the economics could change. Not necessarily collapse, but change. And when you paid trillions, small changes matter. Third, geopolitical exposure. A global company depends on a functioning global system: suppliers, shipping, manufacturing, trade, markets, political relationships. Now imagine a major disruption, a conflict, a trade war, export restrictions, tariffs, regional instability. Suddenly, a beautifully optimized supply chain becomes a vulnerability. The more efficient the machine, the more painful disruption can become. Fourth, innovation pressure. This may be the hardest risk to measure. How do you put a number on the expectation to invent the future? You can't, but the pressure is real. Apple isn't judged like an ordinary company. A successful new product may generate billions, and investors can still ask, is that all? That's the burden of past greatness. The iPhone didn't simply succeed, it changed expectations. Now every future product is compared against one of the most influential consumer devices ever created. That's almost unfair, but markets aren't interested in fairness. So, would a billionaire buy Apple? The better question is, what kind of billionaire? If you're looking for a quick turnaround, no. This isn't a broken factory you can repair. It's not a struggling hotel you can renovate. It's not an inefficient company where you can fire half the staff, cut costs, and double profits. Apple is already one of the most closely watched businesses on Earth. The obvious improvements are rarely obvious. If you're a private equity investor looking to load the company with debt, extract cash, and exit in 5 years, the scale alone makes the idea almost absurd. If you're an entrepreneur hoping to take control and personally redesign the company around your vision, be careful. You're not buying a blank canvas. You're buying a living ecosystem used by enormous numbers of people. One reckless decision could destroy value faster than you create it. But if you're a patient, long-term owner, someone willing to think in decades, the conversation changes. Because then you're not asking whether next year's iPhone sells 5% more units. You're asking whether Apple can remain central to people's lives over the next 20 years. Can it win in AI? Can it deepen services? Can it expand health technology? Can it create new computing platforms? Can it preserve trust? Can it keep attracting world-class talent? Can it continue designing products people don't just use, but desire? If the answer is yes, then the long-term opportunity remains extraordinary. And this brings us to the most important distinction in the entire video. Apple's greatest asset may not be the iPhone. Think about that. The iPhone is enormously important, but products eventually age, technologies change, categories evolve. Apple's deeper advantage may be its ability to combine hardware, software, silicon, design, brand, retail, services, distribution, and customer trust into one system. A competitor can copy a camera feature. It can copy a phone shape. It can copy a software idea. It can copy a subscription. But copying the entire machine, that's much harder. And perhaps that's what you're really buying. So, it's time. Let's score the decision. Millionaire Decision Scorecard. Investment required, 5-star, extreme. This is not simply an expensive business. At a multi-trillion-dollar valuation, it sits among the largest corporate assets on Earth. Very few buyers could even imagine attempting the purchase, and a complete acquisition could require a premium above the public market value. Score, 5 out of 5 for capital intensity. Profit potential, 5-star exceptional. Premium hardware, services, subscriptions, digital marketplaces, accessories, customer relationships, pricing power, a vast installed base. Few businesses have created such a powerful combination of physical products and recurring digital economics. Score: 5 out of 5. Risk level 3, stars, moderate, but complicated. Apple isn't a fragile startup. It has scale, cash, brand power, customer loyalty, and enormous resources. But its risks are serious. Smartphone dependence, regulation, geopolitics, supply chain exposure, AI disruption, future computing platforms. The company is strong enough to absorb mistakes, but not immune to structural change. Score: 3 out of 5. Operational difficulty: 5-star, extreme. You're coordinating global suppliers, product launches, software ecosystems, retail stores, chip design, cloud services, developers, manufacturing partners, governments, hundreds of millions of customer relationships, all while trying to invent products years before the market knows it wants them. This is one of the most difficult businesses in the world to manage. Score: 5 out of 5. Time to recover investment: 2-star long. At a multi-trillion-dollar purchase price, you're not thinking in months, you're not thinking in a few years, you're thinking in decades. And that's before considering the premium required for full control. This is not a quick return investment. Score: 2 out of 5. Future outlook: 4 stars, strong, but not guaranteed. Apple has extraordinary advantages: a global brand, a massive installed base, custom silicon, services, financial strength, deep customer loyalty. But the next decade may bring enormous technological change: artificial intelligence, new interfaces, new computing platforms, regulatory pressure, supply chain restructuring. Apple has the resources to compete. The question is whether it makes the right decisions. Score: 4 out of 5. Final verdict. So, would owning Apple be a millionaire decision? The answer is yes, but with one enormous condition: price. Because Apple may be one of the greatest businesses ever created. That doesn't mean any price is a good price. If you somehow acquired the company at a valuation that gave you a reasonable long-term return, and you had the patience to think in decades, and the discipline not to destroy what already works, then yes, owning Apple could be one of the most extraordinary business investments imaginable. But if you overpay, if you bury the company under impossible debt, if you chase short-term profits at the expense of innovation, if you weaken the ecosystem, if you lose customer trust, then even the greatest company in the world can become a terrible investment. And perhaps that's the real lesson. At the beginning of this video, we asked what it would cost to own Apple. Several $trillion, maybe more? But after everything we've learned, the real cost isn't the purchase price. It's the responsibility. The responsibility to keep innovating when the current products already make billions. The responsibility to disrupt yourself before someone else does. The responsibility to protect customer trust. The responsibility to coordinate a global machine most people never see. And the responsibility to answer one terrifying question every single year: what's next? Because if you buy a steel factory, people expect steel. If you buy a hotel, people expect rooms. If you buy an airline, people expect flights. But if you buy Apple, people expect the future. And the future is the one product nobody knows how to manufacture. So, let's return one final time to that Monday morning, 7:42. Coffee on the table. Your phone rings. The irony? Yes, still an iPhone. The banker asks, "Do we have a deal?" You look at the numbers, the factories you don't fully own, the supply chain you must coordinate, the customers you must keep, the regulators you must satisfy, the technologies you must predict, the trillions you must justify. And now, after everything you know, you make your decision. If you enjoyed today's millionaire decision, hit the like button and subscribe for more deep dives into the economics behind the world's biggest companies, industries, and investments. And now, I want your verdict. If you had enough money to buy Apple today, Would you sign the deal? Or would you invest those trillions somewhere else? Tell me your decision in the comments below. And while you're there, tell me the next company or business you want us to put under the microscope. Because every empire looks simple from the outside, until you see what it actually costs to own one. Until next time, make smarter, millionaire decisions.